We want to stay on UBS and actually bring in now Matthew Luckett. He is a portfolio manager at Balestra Capital. It has about $2 billion under management. So, Matt, we know you came in to talk to us about some of the positions that you're taking in the market, so we're going to get to that in a minute. But I'm just curious. I mean, there is word that perhaps the cause of this $2 billion loss for UBS was in this Delta One business, was it ATF business, equity business, which at least some analysts have been telling us is actually good news in a way for UBS because fairly liquid and hopefully they will be able to unwind the trades if necessary. What do you think, if anything, that this shows about some of the wild cards out there as you invest and as other hedge fund managers invest?
I think it's a good question. I mean, we spend a lot of time looking at the overall financial system, and this is simply an example of how large and unwieldy these financial institutions are, and it's very difficult for them to know everything that's going on in their operations day to day. I don't know anything specific about this situation, but it's clear that these are incredibly large organizations.
Yeah, 65,000 employees for UBS. I mean, Switzerland's biggest banks. But by the same token, I mean, there has to be this measure of control and system of check-ins. We're going to bring more reporters in later on UBS and sort of bring us up to date on the developments. But in the meantime, we do want to talk about the markets because we know, in particular, you've been very active in gold, which has been a pretty solid play so far this year. Is it because you think the world is ending?
We don't actually think the world is ending, but we do think that gold is a good asset to own. We've actually owned gold in our fund for the better part of 9 years. So we've owned it for various reasons. Currently, we own it as an instrument because we believe that for thousands of years it's been a store of value. It's been a unit of trust, and we believe that will continue to be the case. The current economic landscape is such that the central bankers and politicians actually did a very good thing after 2008 in trying to save the financial system by providing a significant amount of liquidity, both monetary and fiscal stimulus. And I think that it managed to provide a measure of confidence in the markets, but the challenge is that because many of these stimulative measures have not had the effect on the real economy and shown real growth, the downside of that is that now the next step to keep things together and provide additional confidence is to, in our view, probably to provide more quantitative easing or stimulus.
And Deirdre, that brings to your point.
Absolutely. I mean, presumably the worry is we're now faced with a position much like 2008, and perhaps the policymakers aren't as prepared to respond. Presumably that's why you go to gold.
Well, we look at it as really this is the third bubble in the last 12 years or so. It first started in a very manageable place in technology equities. That much of that risk was transferred through low interest rate policies to the housing and credit markets. And again, we saw the reaction from a policy standpoint there. The challenge now is that you actually, in terms of this third bubble, we see it as occurring in a much more dangerous place, which is in the sovereign credit market, where banks don't actually reserve for it, where there's significant risk to a break in confidence. And that's why gold becomes a very attractive asset. We think that essentially what governments are doing is they're in an ongoing currency debasement effort to every country in the world wants to have the weakest currency in order to export their way out of and grow their way out of this.
Export sunk to zero, of course, around the world, unfortunately.
Yeah,
but of course, it's impossible for everyone to do that at the same time. So we look at all hard assets as attractive, things that have value that cannot be debased. Gold happens to be something that's very liquid, which we like as an asset class.
And Danny, to you, this speaks of what you expect to hear, what you want to hear, at least from the Fed.
Well, I think the Fed is going to have to act. My sense is that if you like, the consensus about the need for that has been moving in the last couple of weeks. And we heard about how, the comment a moment ago about the American banks being in a better position than European banks, but they're exposed to the same kinds of issues. This is all interrelated. And I think what's happened is the central bankers like me would say the risks have moved seriously to the downside. And that's the big worry. Yes, Europe is a problem, but we're not an island. island in the sense we're a part of a global system. And I think that's the comments that you were sort of talking about. Yes, is that's about your view?
It's absolutely right. I mean, we look at the world as an incredibly interconnected place at this point, and I think that if you look at asset prices today and the correlations across all asset classes, it's very difficult to see that there's any disconnect.
Yep.
And so again, for being a macro firm, we look at things on a top-down basis and try to parse and boil down these big picture views into investable themes. And I think that in the context of this discussion, there's no question that problems that resonate and radiate out from Europe are manifesting themselves in the U.S., in China, in really every developed country around the world.
Matthew, do you hold gold these days? I mean, you've held it, as you pointed out, for the past 9 years, better part of the past decade. But do you hold it these days with its price above $1,800 because you believe that these efforts by central banks, including the Fed, to monetize the debt are going to create an inflationary problem?
Well, the interesting thing about gold, if you look at it in the context of history, it's actually served a very important purpose, either during deflationary periods where asset values are destroyed, particularly credit-based asset values, which is really what we're talking about, and it also works in inflationary periods. And I think the danger, I don't actually know that the Fed or any of the other central banks who are providing this liquidity can actually control where it goes or have the ability to dictate which asset classes it flows into. And maybe they don't really care at this point. But the challenge is...
Well, they do care.
I was just going to ask
They
Danny.
do care. I mean, the issue is it's not exactly clear what's going to happen, but they're going to keep trying. They're going to move across the term structure. They're going to think about different kinds of assets to buy. So they care about it, but the problem is they don't quite understand the transmission mechanism.
Exactly. And I think so from our standpoint, we look at gold as a store of value, as something that will hold its value in times of economic crisis, in times of inflation or hyperinflation, and being able to control that. We're in unprecedented time, right? We've had this massive paradigm shift where the rich countries of the world are no longer rich. Mm-hmm. The developed countries are coming up the curve, but in fact, they still need their consumer economies to grow fast enough to be able to, take over that growth and not rely on exports for the bulk of their GDP. And in some respects, we look at that as a very significant dislocation period. I agree with you. I think we're in a time where our outlook is quite dim, quite dire, I guess. In
the U.S., you mean?
I think globally. We don't look at there being many safe havens. If you think that a lot of people look at the emerging markets as a place where, the demographics are there, certainly the economic trends are there longer term, but we don't think that decoupling effect happens in a very short period of time.
And there's rebalancing going on within economies and across the world. It's this rebalancing, and it's going to take a long time, and that's the problem for the consumer.
It's a problem for everyone. Danny,
Sure.
Our co-host for the hour, sit tight. Matthew, good to see you here. Matthew Luckett
Thanks very much.
of Balestra Capital. We're